Well, it seems like IPOs are back in 2025. There have been 157 IPOs on the US stock market this year alone, and it's only June. So an IPO is an initial public offering. It's when a private company decides to sell shares to the public in order to raise more capital. This generally happens as the business is growing, needs more money to expand, and typically these businesses are doing somewhat well before they IPO, right? That's the hope, at least. We've seen some really big IPOs. Caris Life Sciences, which just went public last week, has already returned 30%. Voyager Technologies, which is a space stock, nearly doubled on their first day of trading. And of course, the now infamous Circle Group, which IPO'd just at the beginning of June, is now trading almost 700% higher than their IPO price. So yeah, IPOs are back, but there's one IPO that I've been really particularly watching, and that is Chime Financial. The ticker is CHYM. Now, on first glance, Chime Financial does not look like anything spectacular. On their first day of trading, the stock popped, but has since settled down to actually near the IPO price. The IPO price for this company was $27 a share. It jumped up into the $40 range and is now back to around $29 a share. So essentially right now, if you were to invest in Chime, you'd be getting the IPO price before that initial pop that happened. A lot of times when IPOs first start trading, people get really excited about the opportunity to invest in a company that they couldn't invest in before or was more difficult to invest in before, and they pile into the stock without really thinking about valuations. But now, it's starting to look pretty attractive to me. So let me tell you why I'm interested in Chime Financial. And that starts with what Chime does. So Chime considers themselves a neobank. So what is a neobank and what do they do? Well, a neobank or a fintech bank is a digital-only financial institution. So think of your typical banks that have branches and locations that you might go into. A neobank caters to a younger audience who doesn't necessarily want an in-person banking experience. They can do everything directly from their phone. Now, what's interesting is, despite the name, Chime is not actually a bank. This Fortune article says Chime is not a bank and does not have a bank charter. Instead, it partners with Bancorp Bank and Stride Bank to provide its services. When we look at Chime's investor relations, they confirm this. They say, through our direct relationships with our bank partners, the Bancorp and Stride, we deliver FDIC-insured bank accounts and innovative products that address the most critical financial needs of everyday people: spending, saving, accessing liquidity, so taking on loans, and building credit, all while avoiding punitive fees. So we're starting to see what their goal is here. They want to cater to a younger audience. They don't want to charge fees. So if they're not a bank, they don't charge fees, how the hell does this company make money, right? So when we look at their Form S-1, this is a SEC filing that all companies must file before they go public, and it sort of airs their dirty laundry, right? It talks about what they do, it shows their financial statements, and it's where we can find most of our information about new IPOs. So for Chime, I found this very telling sentence. We primarily generate revenue when members spend using a Chime-branded debit or credit card, based on fees paid via card networks, rather than fees paid to us by our members. So they're not going to be charging you overdraft fees or monthly maintenance fees. What they're going to do is charge the merchants a small interchange fee every time you swipe your Chime card. So this sounds a lot like the business model of Visa, MasterCard, American Express, Discover, which is now part of Capital One. So what are interchange fees? Interchange fees are transaction fees charged between banks for processing credit and debit card payments. When a customer makes a purchase using a card, the business's acquiring bank pays the interchange fee to the cardholder's issuing bank. Chime is attempting to copy a payment card business model. So their goal is to get members using their bank by offering low to no fees. That's pretty intuitive, right? And then once they're using Chime through their banking partners, they get a Chime card, they start using Chime to pay their bills, they start using Chime at the store, they start using Chime on, their digital wallet whenever they go to buy something, and they collect these interchange fees. And essentially this has a network effect. The more people they can get using Chime, the more transactions they're going to get, the more interchange fees they're going to get. So it's quite an interesting business model, and it's worked out really well for these other big leaders like American Express, Visa, and MasterCard. But is Chime the only one doing this? Well, no. According to an article by Fortune, there is lots of competition for Chime. One of their main competitors is Cash App, which is owned by Square. This article says Cash App is so established that it makes it difficult to compete. And I think that makes a lot of sense. Cash App is in itself a type of neobank. You can pay using Cash App, you can store money on the Cash App or maybe I would just say the Cash App. I'm not sure of the terminology there. I don't use Cash App, but essentially this is a big competitor, also very popular with the younger generation who doesn't need a traditional banking service. However, Chime is still pretty early to the party. This article says Chime is the first US-based neobank to go public via traditional IPO. There is New Holdings, which is a Brazilian fintech, which does something similar. They are targeting Latin America, so it's a bit of a different demographic. And there are some other neobanks that have yet to go public, things like Klarna, which is primarily known for their buy now, pay later services, and Revolut, which is based out of the UK. So yes, Chime is facing competition. However, they are one of the first movers in this space, and they are rapidly growing. It's worth noting one of the reasons why Chime stock is down so much recently, even after their pretty strong IPO. And I think the drop is not fully warranted. So let's take a look at Visa. Visa's stock. Visa is one of the largest payment facilitators in the world. They also charge interchange fees like we looked at with Chime. And their stock is down 9% in just about a week and a half. So the reason Chime is down is partially the same reason why Visa is down. It's this Genius Act, a crypto regulation bill. So you might ask yourself, if you're not familiar with what's going on, why does a crypto regulation bill affect Visa and Chime? They have very little to do with crypto, and that's exactly why they're down. So this crypto regulation bill establishes rules for stablecoins, a type of cryptocurrency that's pegged to the value of another asset, often the US dollar. So the thought here is that now that we have some legislation in place, this bill was just recently passed last week, I believe, it's very possible that stablecoins become a mainstream tool for digital payments and other financial instruments. So the thought here is very long term that rather than swiping your debit card or credit card to purchase something, you're going to transact using stablecoins. So companies like Visa, MasterCard, Chime that have no exposure to cryptocurrency or stablecoins are going to lose out on all of this transaction revenue. And to me, I think that is certainly a possibility, but I think to sell off Visa, MasterCard, and Chime now for something that might happen in the future is very speculative, and I don't think it makes a lot of sense. Barclays actually echoes my own concerns, saying stablecoins' danger to Visa and MasterCard is overblown. Although Barclays recognizes the revolutionary potential of stablecoin technology, it believes that stablecoin adoption will continue to be challenging in the retail payments sector, which is the primary focus of Visa and MasterCard. I completely agree. I think that, yes, I can see a future where we do transact on the blockchain. It certainly has a lot of benefits. However, adoption of this type of thing takes a lot of time. And like I said, it's very speculative. If you believe in this type of future, it makes sense to look into getting exposure to these types of companies, the Coinbases, the Circles of the world that do make money from stablecoins. However, I don't think it makes sense to sell off the legacy payment providers for something that may impact their business in the future. To me, if I can use an example, it reminds me a bit of Uber and the robotaxi dilemma. Do you all remember when Uber stock was trading around $60 a share because of Tesla's new robotaxi cybercab that they had unveiled? Look at what happened to Uber since then. Uber has recovered and is back near 52-week highs. I'm not saying that this is the exact same situation, but I'm saying that often when people worry about a new technology disrupting a legacy provider, it can be overblown, right? So just because Tesla is seeing some success with their cybercab or robotaxi, success being subjective, depending on who you are, that doesn't mean that Uber is going anywhere. And so the people who are selling Uber off are probably kicking themselves because it was way premature. I think that's exactly what's happening with Visa and MasterCard, and I think Chime is getting caught up in that. And I think that oftentimes when the market is irrational, that's an opportunity for a rational investor. And I think this might be one such opportunity. When we look at their S1, we can find their income statement, and we can see that growth has been really strong for Chime. In 2024, they saw revenue of $1.7 billion versus just $1 billion in 2022. So 70% increase in revenue in those 2 years. Nice. I love to see it. And what's also very interesting is that because this model relies on interchange fees, it's a very, very low cost of revenue. So as we can see, cost of revenue is actually declining. So that means their gross margins are expanding very, very rapidly. The problem with that, though, is that gross margins are not the end of the picture. Sure, they have a great gross profit, but look at this. Huge operating expenses. We have transaction and risk losses, member support and operations, sales and marketing, which is pretty large, technology and development, general and administrative, depreciation and amortization. They have total operating expenses of $1.5 billion on gross profit of roughly $1.5 billion. So as you can see, this is not a terribly profitable business yet. So, okay, I've mentioned a lot of risks around Chime. why am I so interested in this stock? Well, let's go over here to my growth stock spreadsheet. This is where I rate stocks on 4 factors. And my goal with this spreadsheet is to try to find stocks that are trading at a reasonable valuation, that have strong growth, that have good market penetration, and have nice margins. So Chime seems to check all the boxes. They have a reasonable valuation on a price to sales basis of 6.4. So typically on my spreadsheet, the average company is trading at 12 times price to annualized sales. So Chime is looking, if you just look at that very specific metric, looks relatively cheap. What we also see is, like I said, strong gross margins, 88%, and those are expanding. Now, these are not net margins, these are gross margins. So the company is not profitable. So what we see is a high PE, high price to free cash flows. But what I see over time is as that network effect takes effect, I suppose, the company's profitability will grow exponentially. So even though they're not terribly profitable right now, I expect that in the future, as they continue to grow, they'll be able to shift focus towards that bottom line and become more and more profitable. What we see is that revenue growth this year was over 30%, 30.4% to be exact. And I love to see companies growing at double digits, especially strongly in the double digits like that. They have a very strong balance sheet with long-term debt to equity of just 9%. And this was helped by their recent IPO, right? When you have an IPO, that raises lots of cash, and they didn't have a ton of debt to begin with. Let me show you what I mean. This is a consolidated balance sheet. So if we just kind of want to look very surface level, I like to use something like this. The company has, as of March 31st, 2025, total assets of $1.4 billion and total liabilities of just $450 million. And of those total assets, we see $650 million in cash. So before they even IPO'd, they had more money in cash than they did total debt. So this was not an IPO that they did because they needed to raise money. This was an IPO that they needed to do because the business was successful and it was a good time to IPO. They wanted to raise the money. They didn't need to raise money. So okay, so everything's starting to look pretty good for Chime. We have a business that caters to a younger audience, which should continue to grow. It has network effects, so as they grow, they become more and more profitable, as we've already sort of started seeing on a gross level. They do have competition, but they are a leader in what they do in the neobank space, but they do need to watch out for Square and Cash App, and their valuation is really reasonable. In fact, back in 2021, shares were valued at over $60. So today, 4 years later, they're trading at half the valuation that they were trading at in 2021. Now, this is not a gauge of the company being cheap, right? You can't just say, oh, the company used to be at 60 and now it's at 30, so it's undervalued. No, that's not how it works. What was more likely the case was that it was overvalued when it was at 60. So you definitely have to make sure that you don't fall into the trap at looking at what a company used to trade at and comparing that to today. Very, very big mistake, especially for beginner investors. So that's not what I'm saying here. What I'm saying is, out of all the times to invest in Chime, this is looking like one of the better times historically, right? If you liked Chime at $60 a share, well, Chime looks great at $30 a share is what I'm saying. And this is a company that I was very excited to see IPO. So the fact that I can get it for near the IPO price and the business fundamentals are starting to look better and better, I'm definitely intrigued by Chime. So to summarize, I think Chime might be a strong, high-risk, high-reward contender for a portfolio. Of course, this is not investment advice. These are simply my own thoughts. And if I were to take a position in Chime, it would definitely be a smaller position. New IPOs are risky. And again, this is a company that is not yet profitable. As with most growth stocks, they are prioritizing reinvesting in the business. We saw all those operating expenses. So this would be a risky stock and not one that I would go all in on, but might consider a small position. So if I do decide to open a position in Chime, what I will do is let my YouTube members know. I do offer a YouTube membership where I post anytime I buy or sell a stock. It's $2 a month and a great way to support the channel if you like content like this. I don't post too often these days, but I'm trying to get more into it. So as there are more interesting stocks that cross my radar, I'll be posting more and you'll get more investing content. So if you like that type of thing, definitely subscribe to the channel. That's it for my sales pitch. Thank you guys so much for watching the video. Please comment down below what you think of Chime. Do you think it looks like a good value? Are you avoiding it? Is there another stock you like better than Chime? Let me know. Thanks so much for watching and have an amazing day.